Nice to see some familiar faces here. As Marty said, my name is Clercq. I'm the founder and CEO of Kickfurther. So my background prior to starting Kickfurther was in about a decade of supply chain management. And then I started my own product business, pretty basic stuff, buy for X, sell for Y, right? Make a little margin, grow a product business. And what we identified was there is this common problem that exists for pretty much every single product entrepreneur across the market, large or small. So before you can sell something, you have to pay for it, right? And that seems really obvious, but it creates this ongoing cash flow gap for every single product entrepreneur. Famously, Phil Knight talks about this in the book Shoe Dog, where he says something like, the only impediment to my growth was financing my inventory, and it was grow or die, and I decided I had to grow, right? And what we see is that large or small, you have to pay to manufacture your goods, often placing a deposit with a factory, 30 to 50%. Then the inventory is produced. A month later, the inventory ships. It's on the water for a month. And then finally, you receive the goods. And if you're lucky, you're selling direct to consumer and you're starting to receive payments back in a few days, right? 2 or 3 days, you're seeing that those payments are processing. If you're selling to a major wholesale account, which almost every major growing product business has to, if you want to get to the quantities of scale that allow you to grow your business, you're looking at payment terms of 30, 60, 90 days. And that creates this ongoing cash flow pinch for the most successful product entrepreneurs. The more successful you are, the more painful this is as a problem. So we've developed what I consider to be a relatively innovative solution. As far as I know, we are the only true inventory asset marketplace. So what I like to tell people is, guess what? This isn't something that's new, right? Trade has existed for a million years, and inventory is the underlying asset of trade. The difference is that today, with the internet, with technology, with everything else that we have available to us, we can now allow direct participation into these physical inventory assets that have been some of the largest wealth-creating assets in the world since the history of, the Dutch shipping tea from China. Now, how does this work? Well, we bring together consumer product businesses on one side of the marketplace that provide Kickfurther with APIs into the necessary data points that allow us to qualify the businesses and qualify the inventory. We verify the information with third parties. We pretty much take the classic trust but verify attitude on all data. So we're looking at bank data, we're looking at real-time sales data from Shopify, Amazon, or others, and we are confirming cost of goods, pricing, and manufacturing data directly with the suppliers that these entrepreneurs are working with. On the other side of the marketplace, we are pairing these inventory opportunities, these inventory asset opportunities with liquidity providers like yourself, high net worth individuals, family offices, right? And what we have done is we've created the first inventory on consignment model where anybody can purchase this inventory for product entrepreneurs. We bundle these inventories together to hit the minimum order quantities or whatever order quantities are required by the manufacturer. And then we are placing the order with the manufacturer and having that inventory produced and shipped, placed on consignment with the product entrepreneur. And this creates a whole bunch of benefits, both for the business, where they are getting the inventory assets they need to grow, but have the opportunity to pay for them as they sell. So true pay as you sell, pretty much the best just-in-time inventory fulfillment that a product entrepreneur could hope for. And on the other side, we are offering our funders the most senior secured position over those assets and the proceeds of those assets. And what you see is that inventory on consignment, it's not new, right? If you look at GE floor plan financing or the way car dealerships fund their inventory, or even famously Bed Bath & Beyond took $140 million of inventory on consignment. That's not what's new. What's new is making inventory on consignment available to this market segment that is otherwise relegated to, let's say, extremely expensive options like merchant cash advance or daily debit, which actually negatively impacts their cash flow, which is kind of the worst thing that you can do to a product entrepreneur. Every single one of them will tell you that cash flow is king. Thus far, we've funded just about $250 million of inventory to date. So we'll hit that. If we don't hit it this week, it'll be next week. We are right on the cusp. It's exciting. So why Kickfurther? Well, we bring expertise in private credit in this inventory asset. We've been doing this for 10 years. Our longevity here and the data stack that we have is unparalleled, second to none, right? It's a very different risk profile when you're funding inventory on consignment. We've built a machine learning model specific to proprietary qualification data points that we've been evaluating since we developed them back in 2017, and we've been looking at this for 7 years. We ran $123 million of transaction data through a machine learning model and have created a really robust inventory liquidity risk model, which we are making available to all of our funders for free on the platform. In addition to that, I think we have, over the last 10 years, assembled just an absolutely incredible team. You know, multiple team members on Kickfurther have 10,000 hours of experience or more in what is an industry that we essentially have created, an inventory asset marketplace. And I'm very happy we've been extremely successful in bringing on just incredible advisors and a great board of directors together that continues to support our ongoing growth. So what does inventory on consignment look like for the funders on our platform? Well, we offer, first of all, a very attractive diversification. Every month, as of last month, we are funding just south of 50 different consignment opportunities for businesses. So within one quarter, you can be diversified across 150 different inventories for different products, across different product verticals, geographically diverse, you know, consumer versus, you know, premium versus economy, product diverse. So diverse across the spectrum of entrepreneurs, location, pretty much everything you'd be looking for, but specific to physical goods inventory. It is very short duration. Most inventory on consignment lasts for, our average turn is, I believe, 5.1 months. And we'll see co-ops, these are consignment opportunities, that will last anywhere between 2 months up to a maximum of 10. So these are assets that are turning relatively quickly. If you talk to product entrepreneurs or you know product entrepreneurs, you know, they'll say more turns, more earns. So typically the more successful product businesses are turning their inventory even more quickly. And what we know is that this is largely uncorrelated, right? So markets go up, markets go down. Guess what? People still need to eat. People still need to go to school. They still need to clothe themselves. They still need to buy accessories for their cars, right? People are having kids. They're buying new baby stuff, so on and so forth. The physical goods economy has much less variability than the stock market has, right? It's much less volatile. And so one of the other things that's not on this slide, as someone mentioned earlier, is that we are also seeing an incredible opportunity today. So somebody mentioned that there's a liquidity crisis. That is absolutely true. As these banks, regional lenders have their liquidity and their balance sheets locked up in long-term treasuries or commercial real estate, that has sucked the liquidity out of this marketplace. And we are seeing an incredible number of extremely high quality, successful product entrepreneurs that need funding for the ongoing growth of their product businesses. So what does diversification look like? What does short terms look like? Well, here are some of the businesses. It's a little bit small, but here are some of the businesses that we have funded just recently on the Kickfurther platform. We've got Drone Sports. So, you know, like drones, that's pretty darn different from Rebel Green, which is an apparel company that sells out of, I want to say California, but I'm not 100% sure. And then we have PA Distribution, very classic distribution company. They buy wood blocks. They sell it to Hobby Lobby and to others. They've been doing this for 12 years. And guess what? They need to keep a warehouse full of wood blocks on hand at any given time, because if Hobby Lobby orders, they have to deliver. So we're funding wood blocks for PA Distribution. And we're funding hearing aids for Audion Hearing that both has a very successful direct-to-consumer channel through their e-commerce website, as well as a wholesale channel, I believe through CVS is one of their main partners. And as you can see, on the average duration, it goes anywhere from Audion Hearing, typically doing PO finance, right? So we're turning over these CVS POs every 2 months, all the way up to PA Distribution, where we're funding a warehouse of wood blocks for 8 months as they draw down on that inventory and pay it back over time. We're offering an attractive, what we call annualized consignment profit. So there's a certain amount of consignment profit is tied to every specific inventory. And as that inventory is sold down, you earn that profit. As the payouts are received by the funders, they can reallocate that into new inventories or withdraw it at no fee on the platform through the marketplace. So what would a sample fund look like? What we would recommend is people would consider, anywhere between an allocation for $1 million up to, we probably have about $30 million of flow available in the coming 9 months. I would recommend that you would be leveraging the machine learning model that we've created and we'll make available to you as a funder. And I would recommend to mix something like 50% of the top tier, 40% of the tier under that, and 10% of the more aggressive tier is what I'll call it. And so that generally, with that kind of mix, you would expect to earn an annualized consignment profit, dollar-weighted loss adjusted of about 14.2%. What does the machine learning model look like? Well, this shows you, for those of us that are familiar with an area under curve analysis, the idea is that straight linear line there is pretty much a coin flip. It means that you're no better than random chance, right? That's a 0.50. When we first deployed our initial checklist scorecard way back in 2017 with those proprietary qualification data points that we started aggregating there, we were just over the area under curve, doing a little bit better on the earlier end of it, which was at about a 0.61. We released version 1 of our machine learning model in March of 2023, so less than a year ago. That performed significantly better at about a 0.70 area under curve. And the latest version of the model, version 2.1, which was released in July and took effect, we parallel test them. So it was released in July, it took effect in August as the master model, is at about a 0.75, which is highly predictive. And what we can share with anybody interested afterwards is to show you how we are risk ranking both on a cash-on-cash basis and pretty much every other metric you would look at for this machine learning model. What does it mean in terms of broad industry diversity? Well, you can see here, this is something like 25 of the different industries and the different amounts of volume that we've driven through those industries. We absolutely see a concentration in food and beverage. This is a great one for us, right? People are ordering these every 3 months. You have to replenish, keep those grocery shelves full. So that is one of the verticals where we see a lot of success. And then just generally consumer electronics, home goods, apparel, sports equipment. I mean, you name it. If you see it on Walmart, in Costco, whatever, we're funding businesses in that category. On a timeline, we introduced, so I mentioned we've been around for a decade. This is showing some of the more recent impacts that we've had to the business. So Bill Ty and Tim Draper invested way back in, Bill Ty invested in 2016, Tim Draper invested in 2017. Very happy to have them as long-term supporters of the business. We hit $50 million funded right around the middle of 2020. As we continue to grow the business out, in 2021, Tom Golisano bought a significant chunk of the business, also has provided a lot of funding for the entrepreneurs through the platform since then. We hit $100 million of inventory funded just about 18 months after crossing that $50 million mark. And since then, we've been growing pretty well. So we deployed a subscription model back in 2021. That moved us up market. We've seen that the average revenue of the businesses we're working with today is about 100% higher than it was a year ago. So you can think last year we were funding businesses more typically in that $1.5 to $2 million range. This year we are funding businesses more typically in a $3 to $7 million trailing 12 months revenue range. So we're seeing a lot of success there. As I mentioned, I do believe that we are the beneficiaries of some tailwinds from the current liquidity environment. But that advantage for us is an advantage for potential funders on our platform, where we have seen the average quality of the deal flow on the platform go from a 40% mix of the top tiers of performance to over 85% in the last quarter, and excitingly, 95% mix of the top tiers of performance in February. So that's the most recent data, and we see that that trend will continue because, surprise, surprise, that's where we are finding a lot of liquidity support and funding support for those categories of entrepreneurs.
We've got only a couple of minutes left. I have some questions from the audience.
Yes, sir. So this is my awesome team. You'll see a whole bunch of us have been together for a very long time. If you guys want to take a look, that's something that I think, whatever, pat myself on the back. I think we've created a great culture and we've managed to retain really strong talent over time. We have an excellent board of directors. Dan DePofi, Dave Bevenzi, both represent Tom Golisano on the board. Bill Ty, one of the seed investors of Zoom, Canva, Wish, just, man of the Midas touch. And John Donovan was the CEO of Lending Club up until their IPO, supported by an amazing board of advisors, including Mike Wisler, who is the Chief Technology Officer at M&T Bank, Tom Golisano, founder and former CEO of Paychex, Jack Donenfeld, who is a Martindale Hubbell rated securities lawyer, practicing for about 35 years now in the field, Alex Boguski from Crispin Porter and Boguski, and Amanda Terry, who is kind of international marketing support. Current opportunity with Kickfurther, 20 million. Actually, we're seeing good growth. So we actually think that there's about $30 million of funding opportunity available in 2024 with an expansion of up to $50 million available in 2025. The expected ACP is about 17.1% in the Pro Plus and just under 16% if you're just looking at the Pro, which is the very top tier category. And we have a special opportunity here, a little invitation for IvyFON members. Just carve that out for you guys, and we'll share the deck. We'll share the QR code. So if anybody's interested, please feel free, reach out to myself, Tisha, or Greg Gordon, our CFO. All right, questions?
I have something from the audience here online.
Great.
So talk about the difference between nearshoring and manufacturing, changes supply chain, et cetera, and how that's impacting. I know that just-in-time inventory was a big deal. Stuff would come in from China, you put it in a warehouse, and then get it out there. How is that changing, and how does it impact you?
I mean, we are what I would call kind of manufacturer agnostic. So we work with manufacturers in India, we work with domestic manufacturers, we work with manufacturers over in Europe. For us, we don't second guess the entrepreneurs. We look at the data and the success of the entrepreneurs, whether they're doing well or not. And so we're not kind of changing their business model. If they're doing nearshore, great, we'll do nearshore. If they're doing overseas manufacturing and building up an inventory and drawing down on it, we'll support them there as well. What we really like to do is see good, strong, successful product entrepreneurs and provide them the funding they need to continue to grow their businesses.
Great. Anything else from the audience? Sean, great job.